All right. Welcome to the webinar we're doing tonight with MLG Capital. It's great to have you here to introduce you to a firm that I've been investing with for a couple of years now. We have with us here tonight Nathan Clayberg, who is an assistant vice president at MLG Capital. Welcome to the webinar, Nathan.
Thank you. Thank you, everyone, for hopping on. Excited to be here.
Yeah, so we've got a great hour planned for you here. We're going to talk about MLG Capital, talk about their investment offerings, and introduce you to them and some of the really cool and unique things that they're doing. We're also going to have some time to do some Q&A at the end, and we'll be going over a bunch of questions that we've collected, as well as common ones that we hear people ask all of our real estate partners. But why don't we start by letting you introduce the firm to us, Nathan? Let's go ahead and bring up your slides, and we'll go from there.
Great. Well, appreciate everyone taking the time to learn a little bit more about MLG. I've got some slides here. Hopefully, we'll get a chance to just give you a sense of what we're about, how we view the market that we're in, and give a chance to answer any questions that you guys have. I always throw a disclaimer up here. The legal team makes me do it, but just that this isn't offering to sell securities. But our team, my name is Nathan Clayberg. I've been with MLG about 3.5 years. Really like working with the company. I actually split my time about 50-50. Half the time I spend working on our deals. The other half I spend working with investors and on the phone and talking about what we do. And it's great that I get to do both. Makes it my conversations with investors more meaningful when I'm pretty intimately involved in what's going on the deal side. And it certainly makes a difference on the deal side when you start to build relationships with people that are investing with you. But behind me, there's a much bigger team, bigger organization. MLG has been around since 1987 on our 35th year of operations. We've done a lot of different stuff during that time. We have a pretty well built out internal team here. We have our 6 principals, who I'll introduce on the next slide. We have about 9 CPAs on staff, 6 attorneys now, land planners, brokers, engineers, all that good stuff that go into making the whole wheel turn. But about 650 people total in the organization across our different business lines. Our principal group, they're an experienced group as well. Tim Wallen is our CEO and primary owner. He's been with the group since 1989. Formerly was a tax manager at Price Waterhouse. That becomes relevant later when we talk about how we do tax planning around our investments. But that's a real area of expertise for him. But there are 5 other principals on our team. They've been investing together on average for about 25 years. Craig Lashley, you see in the top right corner, is our newest principal, joined the firm in 2006, and now really focuses on leading up our property management division, Valiant, manage about 28,000 apartment units in that arm of the business. And then the rest of the principals here are pretty involved in our day-to-day on the capital side. You'll notice down in the bottom right corners, Mike Mooney. He is the founder of MLG, still comes into the office every day, refers to himself as the chief culture officer, but really brings a lot of the backbone and integrity that the firm has. And it's fun to have him still be pretty intimately involved in things. Getting in a little bit to kind of our track record on the investment side, we've been around, like I said, for 35 years. That's led to doing a lot of deals during that time and building a pretty strong track record. Some numbers on the screen here for you, approaching $5 billion in estimated current market value or sold. But you see 2.48x equity multiple since 1987. That's a pretty good batting average. For those who are newer to the real estate lingo world, that means for every dollar we've invested, we've turned it into $2.48. That comes on about an average hold period of roughly 7 years. So pretty strong. Overall return kind of backs into an average annual return in the 19 to 20% range. And something we're really proud of. Obviously, there's no guarantee that you can continue to perform at that level. But we do think, having navigated through multiple cycles, having seen a lot of different things in the world, it does give us a strategy that we believe in and believe can perform regardless of where we find ourselves in the market cycle. What we really focus on here at MLG, a key strategy of ours is getting people diversified. For the first 25 years of the company's history, we did all individually syndicated deals. So that may be familiar to a lot of you. how that works is you find one property you like, you go out and raise money from investors for that one apartment complex or that one industrial building. Like I said, we've got a good batting average. We've had a lot of success in these one-off deals. The trouble with that strategy is you're not getting diversified. Inherently, you're taking on single asset risk. It's like being a stock picker instead of buying a mutual fund. And you might have a great batting average, but every once in a while, there are deals that don't go exactly as planned. There are unforeseen things that come up in the market. And diversification, spreading out risk across a basket of assets, is a way that we really focus on mitigating risk for our investors. We pivoted to this strategy in 2012, really as a response to what happened in the market in 2008, 2009. And it's been a really popular and well-received strategy by the marketplace ever since then. We're targeting diversification in two primary ways. The first is across different asset classes. You can see here we invest in multifamily, industrial, retail, and office. Multifamily is far and away our most preferred asset class. Typically, what we, more recent years, probably been closer to 90% of the investments we make are in multifamily. We'll even see some diversification within multifamily. We invest in a variety of asset classes, look at some value add class B apartments in good locations, all the way up to new construction class A type product, never building it ground up, at least so far in our funds. But we'll buy stuff that's just recently built and get some investors diversified across different multifamily asset classes. Industrial, we really like. Unfortunately, so does everyone else. And so it makes it hard to buy in bulk. But we still find ways to find smaller deals that still get some diversification mixed into the fund. I said multifamily is typically in the 90% range of what we do. Industrial, and we'll call it flex, where there's a component of industrial and a little bit of office in there, make up the bulk of the remainder. But we look at retail and office too. We view those two asset classes very, very opportunistically. Really, we view them as high CapEx businesses. And so unless there's a problem in a good location that we can fix and sell, we're not really buyers of retail and office. We don't want to be there when tenants leave. We want to be the ones putting them in a building and then getting out. So you'll find our strategy in retail and office tends to be more as a merchant buyer, where you're buying at a very low basis in a good location and then out in 2 to 3 years. Multifamily and industrial, we'd be more open to holding in the 7 to 10 year range. Or, if certain deals, if it makes sense to get out in 3 to 5 years, we're open to that too. Talking a little bit about what makes MLG different when you look at the broad span of opportunities in the marketplace. So hit on a few different things here. First, just our general investment strategy. Talked about it a little bit, talked about some diversification, how we're targeting that. But then we always talk about once you've made smart real estate investments, you can really enhance the overall after-tax return for your investors by doing some great tax planning. Some people get a little focused on that prematurely. You let the tax tail wag the dog, as they say, but you got to make money in order to do tax planning, right? So focus on that first. And then just providing our investors a top level of service as they begin their relationship with us. You don't be in business for 35 years without building strong relationships. That's what we're really in the business of doing, both on the deal side and with our investors. And we're looking forward to building that relationship with the White Coat Investor Group. Speaking more geographically, I talked a little bit about the asset classes that we look at. You'll notice on the map here, we have the offices in Wisconsin, Texas, and Florida. We have someone working remotely in Nashville as well. We, in those markets, buy directly. We'll get a little bit more into what that means, but you'll see our reach is far beyond that. Call it Middle America expanded. Generally staying away from the West Coast, staying away from the Northeast. Pricing tends to get a little bit more competitive than we're comfortable with in those markets. But we really like the Mountain West. We like the Midwest. We like the Southeast, and we like the Sun Belt. We're very active in those markets, and really what we're looking for is a variety of things. That the beauty of private real estate, you start talking about stocks or other investment alternatives, markets are designed to be efficient, and public markets have in many ways mastered a lot of the efficiencies that technology and really smart people can come up with. Private real estate is a fractured and fragmented industry. It just is, and that's because people are involved and people make mistakes. Our job as an investment manager is to find those mistakes. And we think we have some strategies in place that really well enable us to do that. But people make mistakes. They don't capitalize on opportunities. They're not renovating units. They're running their expenses too heavy. They're sometimes just not even flat out marketing their properties in a way that makes sense. We need to find those and participate in them for our investors. We also look to buy off market. It's important for us to avoid a competitive bidding process in general. When you get more and more people looking at deals, more and more people putting in offers, that's when you start to see pricing really climb higher and higher. Our job is to find deals that we're able to buy off market, where it's just us and the seller, or just us and 1 to 2 other groups, where there's less competition and the pricing makes more sense. The way we do find mistakes in buying off market is by having key relationships. It's really important in all businesses. It's especially true here in real estate. Having relationships with owners, with brokers, with people in the market who have their pulse on what's going on is really, really important for us. When we look at finding these types of deals that we're looking for, you'll kind of look across the industry and you'll see 2 different general modes of operation. You'll see some groups that are owner-operators, where they are vertically integrated. They deal with cutting the grass, tenant calls, toilets not flushing, whatever the case may be. And then you'll see those that are more just money allocators, where they're finding operators and investing alongside them. Both strategies have some merit. MLG does both, and it marries the two really well together. We have offices, like I mentioned, in Wisconsin, Texas, Florida, and we have a person who lives in Nashville as well. When you have people in the market, you can have your ear to the ground, you can build real expertise, and especially over the course of 35 years, you get a sense of exactly where you want to be and who you want to know in a given market. We think in the markets that we manage, where we buy directly, we're the best group to find the best deals, and we extract the most value from those deals in those markets. However, if you look at the map that I showed you, we have a much broader reach than just Wisconsin, Texas, Florida, and Tennessee. The way we find value in those markets is we do JVs with local operators. We find real estate guys across the country and say, hey, you've been in this market, you have the expertise, you have the right relationships. Why don't you focus on finding the best deals available, and we'll come in for 90% of the equity. When we do that, we retain all the control in the deal. So it's still MLG's deal. But effectively what it does is it takes our deal sourcing group from 6 to 8 people sitting in our office to hundreds of real estate contacts across the country that are sourcing deals and sending them to us. The net result and the benefit to our investors is that we're looking at 80 to 100 deals per month with the intention of buying 1 to 2. And by the way, the 80 to 100 we're looking at, most of the times are being sent to us in a local real estate guy saying, this is the best opportunity we have in Minneapolis or in Indianapolis or in Arizona and Phoenix. They're in the market. They know what they're looking for. And our investors just get to participate in the best of the best. This strategy but really is how we source a lot of our off-market deals. And it ends up being about 50% of the deals we do overall. We think that this is a real secret sauce, a real competitive edge that we have because we do marry these two strategies together. And having the 28,000 units that we manage, we feel like we're very able to vet assumptions on the management side and understand exactly what it takes to grow the operating income and grow the value of a property. So that was a kind of brief overview of our investment strategy. Diving into what's available with MLG right now. Our current offering is our 6th fund. We, like I said, launched our funds in 2012. We've launched a new fund about every 2 years since that time. This fund is looking to raise $450 million. With that, we'll look to buy roughly $1.2 billion worth of real estate. We like to be in the 60 to 65% leverage range. That's very moderate relative to the industry. The more debt you add into a deal, you can enhance your returns, but you also add a significant amount of risk. Our focus is really first and foremost preserving our investors' capital. If we can grow it in a responsible and consistent way on top of that, then that's a win for everybody. So we like to be moderately levered. We like to use longer term fixed rate financing, take some interest rate risk off the table, and we do that, and we're planning to do that here in Fund 6. Like I mentioned, we have some focus on maximizing our investors' after-tax return. For that reason, we have a couple different vehicles by which you can participate in our funds. The first we call our private fund. You'll see that here on the left of the two columns. Private fund is a traditional LLC vehicle, so it's a pass-through entity. It's very common to what a lot of other offerings look like in the marketplace. It allows for us to maximize the depreciation expense that we're passing through to investors. With the tax code as it's currently written, we're able to accelerate a lot of that depreciation into the first year, and we can generate some passive losses that are passed through to investors, which can be powerful tax tools if your tax picture allows for it. We also have our dividend fund. This is great for those who are looking to invest with a retirement vehicle. You can do that and avoid any unrelated business taxable income, or UBIT, which is a tax that can be levied against your retirement account if you're invested in real estate that's financed with debt. The dividend fund structure avoids that. We actually have some folks who will put taxable dollars in the dividend fund as well. It avoids any multi-state filing obligation that comes up. And can be a really good solution for people who are just kind of dipping their toe in. Can talk more about that, gets a little granular, but there's definitely a solution for everybody within the options we have available.
Yeah, this is really unique. I don't know of any other firms that do this, that offer it in either structure, and you basically get to choose. Do you want to have the depreciation pass through, or do you want to avoid multi-state tax returns and avoid waiting on K1s and that sort of a thing? So it's really your choice. I really like it. But just to give you a sense of how much of that depreciation can be passed through in the first year, the K1 I got this is an MLG fund. It was Fund 4. The first K1 I got, it was a $250,000 investment, and my net income was a loss of $157,000. And so you can get a lot of depreciation passed through, just in that first year from an LLC structure like this.
Yeah, that's exactly right. We typically estimate 50 to 60% of your investment coming back to you in the form of a loss in the first year. If you're a person who's done some investing, you have some passive ordinary income, these losses can be really, really powerful tax tools, especially for those, and I'll take a wild leap, for a physician-based blog that may be taxed at or near the highest rates. You start to get some tax-deferred income like this. It can be a really powerful tax tool. One, it allows you to capture the time value of money, right? You're putting money in your pocket today and not the government's. And two, it creates permanent savings because we're offsetting income that's ordinary income. Tax typically, not factoring in state tax, is 40% plus or minus. And when we go to pay the tax when we sell these properties, we're typically looking at paying capital gains and a little bit of depreciation recapture. Still blends out to be in the low 20% tax rate typically. So you're capturing 5 to 7 years of time plus 15 to 17% of tax rate savings overall. It's a powerful tax tool. There's no question about that. So we talked about a lot of this. I've hit on, some of the importance of diversification, having multiple ways to invest in Fund 6. I mentioned the moderate leverage. I'll hit on that again. It's just so important to think about how much debt sponsors are using in their deals. The quickest way to get in trouble in a real estate investment is to be over leveraged. You can get out over your skis really fast. Using an anecdotal example, the most recent kind of tumultuous time in the market was March 2020 when COVID kind of hit the fan. At that point in time, no one knew exactly what was going to happen. The whole economy completely shut down. We looked at our fund in aggregate and said, okay, how much revenue would we have to lose before we would be dipping into our operating reserves and not able to pay the bills? At that snapshot in time, we could afford over a 30% drop in our collections before we were even dipping into our reserves. That didn't involve losing money. That was just dipping into the sizable cash we have on the property level. So low leverage gives you a lot of cushion, and we really believe in that. You'll hear a lot of sponsors tout, high IRRs, and that's great. But not all 20% IRRs are created equal. If you take on a lot more risk to get there, you got to be aware of exactly what you're getting yourself into. So we're really focused on that. And then I mentioned some of the tax efficiencies. We can go into the granulars, but we're utilizing cost segregation studies. We're utilizing bonus depreciation, and doing so is what creates those losses that we're able to pass through to investors. Most important, or one of the most important questions people want to know is how they're getting paid in our structure. We use a European waterfall, and we target all-in returns net to the investor. So that's net of fees, that's net of MLG's promote profit share of 11 to 15%. Like I said, we've outperformed that historically, but we'd rather underpromise and overdeliver. So the way we get you your 11 to 15% is really a combination of three different tiers. The first is an 8% preferred return. It means from the time investors come into the fund, they get 100% of the net cash flow until they've achieved an 8% rate of return. Starting off, like I said, we're buying quality assets, good locations. With how competitive the market is right now, you're probably not going to see 8% right out of the gates. However, investors accrue and compound to that 8%. So what that means is if we pay out a 5% in the early quarters, which is probably more realistic, that 3% difference that's unpaid is still owed to you in future quarters, and it's earning 8% interest until we make you whole on that. Typically, it's going to take us a few years to buy these properties, go in there and execute our business plan and grow the operating income enough that we can get investors current on their 8%. Once we accomplish that, we'll move on to phase two, and that's 100% return of the original capital that's invested. So investors effectively get the first two bites at the apple in our structure, where they get all the cash flow until they have their 8% annualized, and then they continue to get all the cash flow until they've had all their money back. This is called the European waterfall, and it's distinguished from the American waterfall. I don't know why they came up with those names, but that's what the industry uses. But the American waterfall allows a sponsor, say we sell the first of 30 properties in a fund and make $10 million. The sponsor can pull out their $2 million of profit and put it in their pocket, and doesn't necessarily incentivize them to finish all the way through, because their promote is calculated on a deal by deal basis. Within this structure, investors get all of the money until they have the 8% annualized and all their money back. So we sell our first deal and make $10 million. That's distributed out to investors, and we're working for the last all the way through, because a lot of our piece of the profit is stored up in those last couple assets. Once investors have the first two bites at the apple, 8% annualized and all their money back, then we go into our profit sharing piece. And if MLG has performed as a manager, we participate in the upside. Typically, we offer 70% to investors and 30% goes to us. We've worked out a special deal with the White Coat Investor Group that if the group invests greater than $5 million in total in Fund 6, then we'll amend that and actually give you a better deal, 75% to investors and 25% to MLG. So really hopeful that we can get the group there. Would love to have that level of engagement from the White Coat Investor Group, and then ultimately offer improved economics to all involved.
Yeah, I don't have any doubts that we'll be able to get there. My question for you is there a catch-up on that promote?
There's not. There's no catch-ups or anything, clawbacks or anything like that. So you get pretty straightforward return structure here. Any other questions on that part of it?
No. Oh, are you going to talk separately about fees, or if not, why don't we cover that here?
Yeah, good idea. So we have a 1.25% asset management fee. That's the kind of the most relevant fee that we charge. The 8% that we owe you is net of that. So in other words, to get you 8%, we have to produce 9.25%. Then we have some deal level fees that take place as well. We take a 1% one-time acquisition fee on every new deal. That's meant to compensate our team for sourcing, underwriting, and doing all the due diligence on a deal. And then there are some market rate, property management, construction management fees. Like I mentioned, some of our deals we're vertically integrated. We're the manager. We're paying a market rate fee that's typically 3 to 4%, depending on the size of the property and the location. If we're working with a local operator and partnering up with somebody, we'll pay that same fee to them. Generally speaking, that's kind of the cost of doing business in real estate. You're paying someone a management fee, but we make sure we keep that in check. Similar with the construction management fee. If there's a large construction project, typically we see anywhere from 4 to 7.5% paid as to someone for overseeing that. Again, if we're the ones doing it, we'll take that. If someone else is, we'll pay that to them. There are a few other smaller fees. Our deals include a small allocation for legal expense. We do all that in-house. Typically, it's $40,000 to $50,000 per deal in the scope of a $50 million plus deal. Not super material, but happy to provide a summary of all other fees that we're able to have. But those are really the big ones.
Thank you.
So just hitting briefly on that's kind of covering MLG's offering, MLG's strategy, but want to talk about the way we view the world right now. It's a quickly changing world. We've seen it in the past few months where the interest rates have gone up 100 basis points and then now they're back down 40, and it's a dynamic environment. We want to talk about why we still believe in real estate in even in the times that we're in right now. The number one question we get asked right now is, well, how is real estate going to do in a higher interest rate environment? We've been, 10-year Treasury has been at historic lows for the past few years. Can real estate handle higher interest rates? Our answer, generally speaking, is yes. And we have some thoughts on why. What people often don't ask themselves when we're entering into a higher interest rate environment is, why are interest rates higher? Typically, it's a result of an inflationary environment, and that produces revenue enhancers at property levels. That means higher rents, means higher occupancies, means lower concessions and delinquency, and ability to grow the value by growing the revenue at your property. Higher interest rates impact real estate really in two different ways. One is it impacts your cash flow, right? If your debt gets more expensive, you're going to be able to distribute less to investors. But then it also has the potential to impact your overall valuation, as cap rates are somewhat correlated to interest rates. Now, seeing these revenue enhancers, we believe, really starts to offset your impacted cash flow. Where it starts to hurt you is if you're using a lot of floating rate debt. We assume, using our 60 to 65% leverage, if your debt is floating, that you need to increase your revenue by 5 to 7% for every 1% increase in interest rates. So assume interest rate goes from 3 to 4%, you need to grow your revenue 5 to 7%. Fund 5, as a kind of anecdotal example here, launched in January of 2021, was acquired from January through just actually as of the last couple months. So relatively new properties. Most of the properties have been held on average about 6 months. We've already seen almost 5% effective rent growth across the entire portfolio. And if you look at just the move-ins, last 90 days of people who have moved in, we've seen almost 12% rent growth from where we acquired these properties. That's just in the first year, but it shows the power of inflation and multifamily being able to be a hedge against that. We're able to grow our revenues in step with that. Now, this 5 to 7% isn't an annual need. It's just a one-time bump needed in order to maintain your cash flows. We do have some floating rate debt in our funds. Typically, we like to be at least 70% fixed. When we do use floating rate debt, we buy interest rate caps to mitigate interest rate risk going up too high. If you look at Fund 5, for example, as of today, about 72% of our fund is financed with fixed rate debt. The other 28% is floating with cap in place. If interest rates go crazy and all of our deals are taken all the way up to their cap, it would result in a weighted average interest rate of about 4.08%. As of today, we're sitting about 3.6, 3.7%. So we really mitigate financial risk by using a lot of fixed rate debt. When you see revenue growth with fixed rate debt, that just means higher distributions to investors.
Have you run into any problems on the back end from all that fixed rate debt, having to pay yield maintenance or prepayment fees or anything like that?
It's really important whenever you're selecting your debt to align the financing strategy with the asset strategy. You don't want to use 10-year fixed rate financing on a deal you intend to hold for 2 years. And the reason that we float certain deals is because we envision a scenario where we want to get out of it sooner. A lot of times that means we're going to go in, we're going to do a quick value add, and then we want to sell. If we envision a deal that we're really comfortable with the location, we're comfortable with the product, we might put 7 to 10-year fixed rate financing on it. And in that fact pattern, we're fine to hold for that duration and avoid those prepays. So I think using a smart financing strategy is a really important part of maximizing value, so you can avoid those additional fees when you're trying to sell. You can see here, this is funds 1 through 5 current composition. You can see we're at right around 61% overall. It's important to note funds 1, 2, and 3 have already returned a lot of investor capital. Fund 1 and 2 are entirely returned and are just going through selling the last few properties. Fund 3 has returned, I think, roughly 35% of investor capital, with the last few deals about to be sold here this year. And then funds 4 and 5 have been much more heavily weighted towards fixed rate financing. Like I mentioned, just taking that risk off the table overall. I'd mentioned, the impact on cash flow from higher interest rates. The other question you have to ask yourself is, how are higher interest rates going to impact real estate valuations? We talked about the ability to grow revenue, but so much of any economic system is predicated on supply and demand. The availability of debt in the market and the availability of equity right now, there is so much money chasing real estate. The competition almost is a stronger force than interest rates, is what we're seeing. Now, higher rates certainly have an impact on valuations to some degree, but we think that the amount of competition in the market is going to limit that negative impact overall. We've also started to see in the more, let's call it 5 or so years, enhanced lender terms. The concept of interest-only debt wasn't around 10 years ago, but now you can oftentimes get 10-year fixed-rate interest-only debt. Makes it really attractive and really ultimately can continue to keep valuations where they are. A lot of people assume that you're going to see higher interest rates and therefore automatically you're going to see higher cap rates. In concept, that might make sense, but that's actually not how it's played out historically. If you look at this period here from late 2016 to early 2019, the 10-year Treasury moved 140 basis points, went from 1.6 to 3%. During that same time, you can see cap rate trend data for each of the different asset classes. They actually stayed relatively flat, or in some cases even fell during that time. Now, what we've seen in the last, call it 120 days, where the 10-year has a similarly dramatic move, but condensed into a period of 4 months, it has thrown the market into a little bit of a pricing discovery mode. But even so, we're still seeing cap rates well below their kind of long-term averages. We may be seeing a softening of 25 to 50 basis points. We're confident that as the debt markets stabilize, we're going to see valuations kind of continue close to where they have been the past year or two. I talked a lot about supply and demand. It's very important to consider when you're building an investment strategy. Overall, if you look, multifamily, 97.6% occupied, industrial, 95.8% occupied. Those are two storylines right there that tell you that the supply and demand equation in multifamily and industrial are very intact. Of course, you have to drill into local markets, local submarkets, and make sure that's still true on a local basis. But broadly speaking, the country needs more housing units, and we can't build them fast enough or at a price that makes sense for the people that need them. I mentioned earlier that we're not that interested in office. You can see why. It has systemic vacancy issues, 88% occupied nationwide. Problem with office is a lot of times companies have, they want a new corporate headquarters, something sexy and shiny, and they just go build it, even though they don't necessarily need it. It distorts the overall picture of supply and demand, and that's a big reason why we don't invest in office significantly. Retail, 95% occupied. That surprises a lot of people, but the bricks and clicks are kind of coming back into balance here. We're seeing that there really is real demand for in-store retail across the country. Doesn't change the fact that it's a very high CapEx business, but we do think that there could be unique opportunity there as somewhat of a contrarian play here in the next couple quarters. Hitting on some of the demand drivers, it gets a little boring economics here, but it is important as you formulate your thoughts around real estate. The population is continuing to grow. People are getting married later. They're moving out and forming households on their own sooner. And as a result, we're seeing households forming at an average of 1.02% since 2000. The population is growing about 0.7%, so 0.7% per year in this over the same period of time. So you kind of have a built-in demand driver just with population growing and households being formed in that directly impacts multifamily and the need for housing units. On the supply side, ever since 2008, 2009, supply has been muted, creating an estimated 1.96 million unit shortage in total housing during that time. You can see the chart here, the blue line on the horizontal axis showing average supply since 2000. And we're just now starting to get back up over that line as we've been climbing up since 2008, 2009. What can be built in terms of supply is being built at a much higher price point than ever before. Home prices are up 95% since 2012. Rents are up 57%. It's making it really challenging for people to buy homes, which ultimately is not a good thing, but it does create a real strong argument for the need for more rental units and affordable rental units at that. You can see some similar data here. I'm going fast, Jim, so stop me if you have any questions, but construction costs are going up 3.5% per year since 2000. A lot of people are surprised by this, but the average rent growth from 2000 to 2021 is only 3.1%. You had some times of very flat or even negative rent growth that distorted that line. And obviously in more recent years, we've been catching up. But if construction's been growing at 3.5%, rental rates are running at 3.1%, there actually should be, in theory, some delta there that's still able to be captured as rents, in theory, should grow at a similar rate to cost of new construction. We're seeing this as we look out across the market, new supply that is coming online, even for relative to properties that were built within the last 5 to 10 years. You have to charge rent structures that are $300-$400 higher in order to make the numbers pencil on the new construction side. Higher interest rates, rising cost of construction certainly impact new construction just as much, if not more, than existing acquisitions. And it's making it really hard to build right now.
Not to mention, you just can't get the stuff to build with. I think anybody who's tried to do a renovation understands that these days.
That's exactly right. We always look at the available land in an area when we're making a new acquisition, but it's always been kind of 2 years to get the materials and build it, and that timeline might even be pushed out further by now. That's all I had for you. Kind of the 30,000 foot overview of MLG and how we view the market. Hopefully that was insightful, but would love to answer some questions.
Sure. Let's get into just the details for Fund 6, which is the one you're currently raising money for. So if you want more information on this, by the way, go to whitecoatinvestor.com/MLG. That's the link to use to get more information on MLG. But tell us about what's the investment minimum for White Coat investors for Fund 6?
Anyone who's looking to invest taxable dollars, meaning non-retirement account money, is $50,000. If you do decide to use a retirement account, we work directly through your custodian. So if you have money held at Schwab or Fidelity or whoever else, we're approved on most of the platforms, and we can accept your money without, you don't have to take it out or anything like that. But we do have a slightly higher minimum for retirement account money at $100,000 just to deal with the extra compliance we have to jump through.
Okay. And what should people expect out of the life of Fund 6? I mean, over what time period are you going to call capital? How long is the hold period? Approximately how long till you start returning capital? And how long will that period be?
Yeah, great question. So typically, if you make a commitment to MLG, on average, it'll take us roughly 60 to 90 days before we actually take your money. So from a planning perspective, keep that in mind. Once we call your capital into the fund, we'll call 100% of it at once. And that's when you enter into those 3 tiers I talked about earlier. The first phase where we're accruing that 8% preferred return typically is going to run for, call it 3 to 4 years, where we're ramping up to the 8%. Probably have a period of time where we're just sailing at 3%, or excuse me, at 8%. And then move into phase 2, we'd target returning all of your original capital within 6 to 8 years from when the fund begins. You'll probably start to see some of that money come back to you in chunks in years 4 and 5, with the goal of having that fully accomplished in years 6 to 8. In previous funds, it's actually been a little bit faster, but we really want you to come in thinking 6 to 8 years, this cash is tied up. And you just never know where the market's going to be 5 to 6 years from now. Once you have 8% all your money back, with that last 75-25, hopefully is where we'll land. But that last profit sharing phase runs about 2 to 3 years. So you're kind of looking at an all-in life cycle, about 10 years. Your money's back in your pocket in roughly 6 to 8 years.
And is there any liquidity options in less time than that?
There are no defined mechanisms for liquidity. So if emergencies come up, like I said, we're in the relationship business. We've worked with people. We'll help you figure it out. But the expectation is, real estate's an illiquid asset class. You would invest capital that you're not reasonably going to need to expect or need back in the next 8 years.
Okay. All right. And let's talk a little bit about, kind of some of the decisions that MLG's made. For example, you've decided to raise these funds, new fund every couple of years, lock it up for 10 years, et cetera, and then return the capital. Why not an evergreen fund? Why do you decide to have these defined funds? Fund 1, 2, 3, 4, 5, 6, and presumably 7, 8, 9, 10.
Yeah, there are a couple of reasons that we do it that way. One, we have in our funds probably 1,500 to 2,000 investors per fund at this point. A lot of them have competing objectives, and some of them want their money back, some of them don't. The way we accommodate for that is, give people their money back and have another option available for them to roll it into, and that tends to work pretty well. Two is, a lot of times when you've extracted the value from a real estate investment, you've gone in, you've executed your business plan. Typically at that point, your value is just growing at inflation, right? In our mind, it makes more sense to recycle that capital, get it put back to work in a deal that's going to earn, in that 11 to 15% range versus just growing at, whatever 2 to 5% inflation you might be seeing in that given market. The third reason is we actually think there are some real tax advantages to selling properties. When we pass through, when Jim got his $150,000 loss, and that's true for a lot of our investors, those losses, if you don't have other passive ordinary income that you can use them in a given year, they're just suspended and carried forward. By selling properties, we trigger passive capital gains and allow for the use of those losses. And ultimately, for folks taxed at or near the highest rates, we estimate that we can add 1.5% to 2% in your net after-tax cash flow by triggering and freeing up the use of those losses. So we do that, and what we find a lot of people will continue to do is when we send them back money, they'll roll it right back into the next available opportunity, and they'll start to just the process over of getting a new fresh batch of losses.
Okay. And dividends come out quarterly. That's going to be the same for Fund 6, right?
Yep, that's right.
And you showed us a lot of markets. You guys invest all over the country, just about, other than the Northeast and the West Coast. How did you choose the individual markets that you're looking for properties in?
Yeah, broadly speaking, you want to be investing in markets that are experiencing some robust job and population growth, right? You want to be in places that are growing, not shrinking. You want to be near the best employers. You want to be buying into a story that the market overall is going to be doing some of the work of creating appreciation in your asset. When you look at the Midwest and you look at the Sun Belt and you look at the Southeast and the Mountain West, there are a lot of markets in those regions that very much fit that description. And we want to be participating in those markets. You talk about markets like Dallas or Phoenix or Atlanta, very hot markets, but experiencing significant growth on both the rent and value side. You'll talk about some other markets in the Midwest, maybe Indianapolis, Minneapolis, even Des Moines, Iowa. The growth may not be quite as go-go as Dallas or Phoenix, but you can buy it at higher cap rates and create some real yield that is really beneficial in a fund. So we like to marry together those things. But ultimately, when we're looking at a deal, we're really drilling down even more importantly into the submarket that the deal is in. We want to be in the best school districts. We want to be near the strongest paying, highest quality jobs. We want to be near high income, strong home values, areas that in theory during a recession are going to fare better than those that are maybe a little bit lower quality in those areas.
Now let's talk a little bit about risk management, about reducing the risk. The longer I invest, the more I understand it's far less about seeking returns and far more about managing risk. You talked about a couple of the ways that the fund manages risk on a fund level by limiting leverage and by diversifying. What about on the individual property level? Can you tell us a little bit about your underwriting process and your risk management process there?
Yeah, well, the first thing I'll say is, and I kind of alluded to this, our properties are very well capitalized. Typically, you see a lot of groups really try and skinny up the amount of money that they're putting in their capex and their operating account at the property. We would rather err on the side of having more money than we need, and that just gives you a little bit more cushion to deal with whatever comes up at the property level. But also, I would say our underwriting process is pretty thorough and pretty conservative just in general. You get a little more technical here, but so much of the overall returns when you're creating a pro forma hinge on what you're assuming for the exit cap rate. What is someone going to pay for this property 5 or 10 years from now? Our exit cap rate assumptions, I would say, are uniquely conservative relative to the industry. I know that because I mentioned we look at a lot of deals from sponsors across the country looking for us to invest in their deals. They're assuming exit cap rates that are really close to what they could sell it for today, but it doesn't give any cushion for the market to change over the course of the next 5 to 10 years. We like to assume exit cap rates at least 50 to 75 basis points above where the market is today, so that if we do see dramatic changes in the world, we're prepared for that, and that's going to put us in line with our pro forma. If market stays the same or improves or doesn't get 50 to 75 basis points worse in terms of cap rates in that area, then we're going to outperform in many cases. That right there is a critical assumption. You'd be shocked at how sensitive the numbers are to assuming a 5.25 versus a 5.75 exit cap. But it does matter a lot, and that's one thing we're really sensitive to.
Now, when people, if you're calling capital, raising capital over 1 to 2 years, some people are early investors in the fund and some are later investors in the fund. Can you talk about the pros and cons of each?
Yeah, there really are pros and cons to both. I think, coming in early in the fund, you start the clock on accruing your 8% preferred return. If you've got somewhere else that you can park cash and accrue that rate of return, then, that's great. But typically we find a lot of people don't have as reliable of an option for that. So sometimes it makes sense to come in and get that going right away. The other benefit of coming in early is the sooner you invest, the sooner you can get some of those passive losses we talked about. Time value of money would tell you that it's better to have those today versus tomorrow. And so we're able to provide those to early fund investors. Now, if you invest later, you still get losses, don't get me wrong, but you maybe lose out on some of the time value of money there. Coming in towards the end of the fund, some people like that because they have a little bit more visibility. The assets in the fund are more built out, and you can see more what you're investing in. And then it also can create a shorter lockup period, because if you come in at the end of a fundraising period, we're still looking to return capital in 6 to 8 years from fund inception. You could be in at the end of a 2-year fundraising period, and that looks more like 4 to 6 years for you. The way I kind of summarize the benefits is early fund investors are likely going to have a slightly higher multiple and a lower IRR, because multiple means more cash has been put in your pocket over time with the 8% preferred return. And IRR is such a function of time. Late fund investors tend to have a little bit lower multiple, but higher IRR. So I think it really depends on what your objectives are overall.
And what do you anticipate the capital raising period for Fund 6 to be? When did it start and when do you expect it to end?
We just launched at the beginning of May, so we're relatively new here. Fund 5 was $350 million, and it was raised entirely in 14 months. I would expect that Fund 6 would be, probably in the 18-month range, but it's really an either or. We'll either raise till we raise the total $450 million, or December 31st of 2024, whichever comes first.
Okay. And, there's a lot of people that look at the public real estate markets and they go, man, I can have daily liquidity here and fairly decent returns. What would you say to an investor who wonders why they should invest with you instead of in the public real estate markets?
If you're looking for diversification and you want real estate to be part of what makes you diversified, if you track public REIT indexes relative to the S&P 500, you'll find that they're actually pretty correlated. They're traded on all the same exchanges as traditional equities. When market's up, REITs are up big. When market's down, REITs are down big. We saw that just recently, 2020, when COVID hit, REITs were down 30, 40%, just like the rest of the market. During that same time, private real estate probably saw a 3 to 5% change in values. Honestly, we don't know because we just held and didn't sell. It's not reported every day like it is in the public markets. I would never tell someone that there's no place in your portfolio to be invested in the public market. But if the goal is to get diversified, private real estate has a relatively low correlation to what's going on in the public market and can provide some diversification that way. The other thing I tell you is private real estate has more potential for benefit on the tax side. Public REITs can't offer a lot of the same pass-through benefits that we can, and depending on what you're looking for, that can be a really compelling reason to invest in private real estate as well.
Do you think there's an illiquidity premium? Do you think you get paid more for being willing to be illiquid for 10 years?
I think so. I mean, like I said, we've generated on average over the last 35 years, average annual returns of somewhere in the 20% range. I think that would beat most public REITs that I'm aware of. And even our targets of 11 to 15%, I think are would be a premium to what at least I would forecast and what's been recent performance for a lot of the public REITs available.
So let's talk about your firm in relation to your competitors in the private real estate space. Why would an investor choose to invest with your company? What sets you apart from your competitors?
Yeah, well, the reality is the last 10 years have been a good time to invest in private real estate. If you've invested during that time, you've probably made money. There are not a lot of groups that have been around for 35 years and seen multiple different cycles, seen pretty much everything the market can throw at you. Being with a group that has invested through cycles is really significant. I think there's also some differences in just simple investment philosophy. We've hit on a lot of them. Many groups are still doing the one-off deal model where, you may hit a home run, you may take a swing and a miss. Potential exists for both. Many groups are still using high leverage. You can find other moderate leverage groups, but a lot of what we see from other players in the private real estate world is still taking out 75, 80% debt because you can get it, because it makes the returns look really good, especially if you're a sponsor getting paid to promote. Our philosophy is just a little bit different than that. But I would say the combination of a group with a real track record and our general philosophy is, like I said, if you're looking to hit home runs every time and maximize your return, but you're willing to take the risk that it requires to do that, then we may not be the best fit. But for those who have made their money in life and want to grow it and preserve it in a responsible way, MLG tends to be a really good option.
Awesome. And about how many assets do you expect to go into Fund 6? Are we talking about 15 assets, 30 assets? What are we talking about? How many different properties will be going into that fund?
Yeah, I would like to be 30 to 35, somewhere in that range.
Okay. And how many have been purchased as of now? I mean, we're recording this in July. It's only been a couple of months the fund's been raising. Have any assets been purchased yet?
Not yet. First closing is July 21st, and have a few more planned to follow subsequently in the next, call it 30 to 45 days. So we're well on our way with Fund 6, looking at actually some nice industrial product to start off the fund, hoping that can come together. Then have a couple of really nice multifamily deals as well.
Okay. So let's talk about your ideal investor. Who's your ideal investor? And conversely, who shouldn't invest with you?
Well, for us, you have to be accredited. We're a accredited investor only offering. So that's kind of the first box that needs to be checked. For those who are unaware, that means that as an individual, you've made over $200,000 for the last 2 years, or as a couple, you've made over $300,000, or you have a net worth of greater than $1 million. That's going to be the first thing we verify. But I'd say the second thing is we're looking for folks who are looking to build a longer term relationship. Many of our investors, I think the number of investors who invested prior than a year ago, like 70% have already reinvested with us. We're looking for those who want to continue to build their portfolio, and we want to be a part of that. And some investors will give us their money and they don't want to hear from me. They just want their checks every quarter. Some love to dive in.
That sounds familiar. That sounds like me.
we love that, but we have plenty of investors who want to dive in on each property and understand what's going on. We love that too. We're really open to whatever relationship the investor would like to have with us as their manager. We just want that relationship to extend over multiple funds and multiple investments.
Awesome. Well, we sure appreciate your time putting together this webinar for us, as well as the special opportunity we have for white coat investors, assuming we raise $5 million for the fund. For those who are looking for more information on MLG, you can get that at whitecoatinvestor.com/MLG. Nathan, anything else we haven't talked about today that we ought to cover in this webinar?
I think we've hit it all. Appreciate everyone taking the time to listen to my rambling. But like Jim said, if you have other questions, feel free to visit the webpage, or I put my contact information. Feel free to reach out to me as well.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.